Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today as we have a market day off. We are mourning the death of former President Jimmy Carter today. So thought it would be appropriate today to get back in home studios for today's podcast since we have a little bit of extra free time and I got a lot to talk about. We had a Fed meeting that kind of blew up the quote unquote Santa Claus rally. They didn't take away Christmas, but they certainly took away all the fun. And then we also have some pretty historic news to cover regarding the start of 2025's first five trading days, which is very important. Something we've talked about the last several years. We'll talk about again here today. So very excited to share all this information with you all, and got a lot more good things to talk about. The end of February. February 26th, Shepherd Wealth Management is going to be hosting a client event. We're going to be doing some celebrating of hitting some very big milestones, SEC registration being one of them. And we're also going to meet some new folks there that are interested in being Shepherd Wealth Management clients. It's going to be at the Metropolitan Club. You need an invite to get in, so don't just show up there and crash the party. But for the client, this is a podcast for our clients. Although, if you are new to the show and you're not a client, thank you for watching this. Please like, share, and subscribe to the program. That way, every time we drop these every 2 weeks, you'll know about it. You can share it with some of your favorite friends and family members that are investors and looking to get an edge. What we try to provide here is factual data, much like the news provides factual data. The difference is the news does a good job of scaring the hell out of you most of the time. All that has to do with them being a for profit business, meaning that they need to sell ads. The best way to do that is to keep their audience engaged. And the news understands behavioral finance just as well as I do, which is a study on how human beings make decisions under stressful circumstances relative to their money. And what we found from that study, which you can get a PhD in from every major university these days, is that humans are hardwired with these emotions called fear and greed. And when it comes to investing, humans feel losses twice as much as they feel good about making a gain. And because the news understands that you're more engaged, you're twice as engaged with your emotions and your thought processes when you're talking about things like money under stressful headline news. That's why you see all that stressful headline news, and the news does a poor job of providing you historical context. And that's what we do a really good job of here, I think, at Shepherd Wealth Management. That provides us with an edge for our clients. And why that provides us with an edge, it does two things that are very much in your favor. Number one, Warren Buffett talks about the primary reason individual investors don't achieve the results they're looking for consistently is they cannot control their emotions or their temperament. So, this is our way of controlling those emotions is getting our brains to wrap our mind around the historical context of whatever circumstances that we're dealing with that the news is blasting 24 hours a day, both on the news media as well as your personal cell phone. So it will help you control your emotions by understanding how other human beings have behaved. In other words, how they've made decisions under very similar circumstances, usually outside of the global pandemic, which shut down the whole global economy for 18 months or so. There's always been a precedent, regardless of whatever it is. We can say, hey, look, in the history of whatever the headline news is, we've been through this 17 times over the last 65 years, and here's what the results were for the S&P and the various sectors that make up the S&P. So it gives you some ability to gather control over emotions, but it also gives you an edge on performance because it helps you understand what the risk and reward is of making whatever investment decision you think is most appropriate for your financial situation. So that's what we do here at Shepherd Wealth Management, on top of providing unmatched service. And we'll be able to celebrate all of that at the upcoming event here in February with our clients. We're going to try to capture some of this for the folks that are not current Shepherd Wealth Management clients. That way, maybe you can be a client for the next event that we do. So we'll capture some of that as well. But as welcome to 2025. Any thoughts about the new year as we get started here today?
Yeah, as promised to me when I was in grade school, I'm waiting on my flying car. So that's really the big thing, flying car, little machine in my wall that when I walk up to it and just say fish sandwich, it prints one out, just like
Yep.
Star Trek, that's what I was told.
Yeah, yeah, and
Growing
then
up in
the
the 80s and
Jetsons.
90s, I thought
That's
we would
right.
be there.
That's right. You got the Jetsons, I was kinda waiting for one of those drones just to fly by while I'm driving down I-71, to drop off my daughter for school, just drop off, like, a little coffee or, maybe a bagel,
Oh,
something
yeah.
like that, while you're cruising.
Yeah, I have that fantasy too that like GPS and drone technology and then like auto, driverless cars. So like you can just like sit back and do your work while that'll just all sync up and you're like, oh man, I need a burrito right now. And then your Chipotle just like flies into your car, you're like, heck yeah, dude. This is
Well, with the new baby that we had here, my wife for Christmas, one of the presents that she wanted, we got our first robot, one of those little vacuums that just roams around the house,
oh yeah.
sweeps up stuff. So it's our first robot. It's our first dabble into that sort of technology, I guess. I'm looking forward to seeing how that all goes down. But yeah, speaking of the future, and this is off topic since you brought it up as
I did. It's
before we
my
get
fault.
into before we get into the meat and potatoes of today, Jensen Huang, the CEO of NVIDIA, which if you don't know who NVIDIA is, um, you should.
Where are you?
So,
Yeah, where are you living?
lar- largest chip manufacturer. Check out the stock price. It's been amazing. So anyway, without getting into NVIDIA's stock price and performance, Jensen Huang yesterday, he just like he didn't do anything for anybody that is in the quantum computing business. I don't know if you saw this yesterday, Ez, but he was on CNBC at a conference talking about Blackwell chips and other things that NVIDIA is doing and rolling out, and should be pretty exciting to watch from a profitability perspective going forward. He was just like, "Hey, we're like 15 years or so, or about, from quantum computing being like what everybody's talking about it potentially being." And all of the share prices were down 30 plus percent. I think one of them was down like 45% yesterday or something like that. So anyway, all these quantum computers they need NVIDIA's chips. Maybe there'll be other competitors, I'm sure, over the next 10 to 15 years. But yeah, that was a rough day for all of those. And I've had a lot of clients, not a lot, but I'd say like 10 to 15% of clients calling over the last 12 months or so asking about investing in quantum computing types of companies as like, hey, let's invest for the future, kind of like what we're doing here with Nvidia and some other positions. And I just had a difficult time with it because one, I don't really know when this is going to be a true game changer for efficiency and productivity and all the things that we want quantum computing to actually do. Therefore, we don't really know when it's going to be profitable, right? So that was the difficult thing I had. But now you have all this artificial intelligence investing that is not going to change anytime soon. And the one thing that Jensen kind of mentioned, but the news didn't really reiterate, he's like, well, it could be 15 years, but who knows? It really could be 15 months. Nobody really knows because of a lot of things that artificial intelligence is hopefully capable of doing that might accelerate the path of quantum computing. But nonetheless, the news just kind of took, hey, you got 15 years to go here, and the stocks just took a dump.
Yeah, I think anybody can see how he was hedging his keeping his stuff close to the vest on that one. 15
Yeah.
years, maybe 15 months. That is such a
Yeah.
discrepancy where he's like, "Actually, I got it in the car right now. I just don't wanna tell anybody about it."
Yeah. The news, though, they do the news thing. They're like, yeah, they left out the 15-month thing. Like, yeah,
Yeah,
15 years, and then just
yeah.
every one of those stocks just taking it right on the chin.
I mean, obviously, he's playing it. He's playing them. Like, there's no way. Did you like speaking of quantum computing? One of my favorite things to kind of just follow along with, and I want to tell everyone and be upfront that I have no idea what I'm actually talking about. It's just exciting to me. Is this idea of people trying to figure out how to like teleport things? Have you seen that? And the
No.
big thing is like quantum entanglement, where they basically somehow make atoms on one end of the US and another same atom on the other end, they somehow tie them together. So when you change one in Los Angeles at the same moment in time, it changes the other one in New York instantaneously. That's like as close as they gotten with like teleporting things. However, this past week, they just dropped a white paper where someone did that with a quantum computer through the internet.
Wow.
And I
Sounds like
that's as far as I can get with it. It just still blows my mind, but I look for that stuff all the time, but I don't know how it works really other than that. So,
sounds like the butterfly effect to some degree.
yeah, I mean, either we're all just gonna wake up and instantaneously have like, be basically limitless. Everybody's gonna with like 2 sets of arms and just be these uber
Yeah.
humans,
Yeah.
or we'll get sucked into a black hole and not even know it, something like that. But
Hey,
with
no,
those
regardless.
comments by, But yeah, with those comments from NVIDIA, I did see those and I was like, they already know when they're doing it. And it's not 15 years. They just don't want to scare everybody, is what I think. Cause, look at the waves that people
Yeah.
didn't even know what AI was. They thought it was actually some thinking machine and not
Oh
just
yeah.
like, a basically, we've talked about this all the time. It's a really good version of a genius playlist where it just takes things that already exist and, runs progress through it. People
Well,
freaked about that. So I
yeah.
can imagine if he was like, "Hey, we have quantum computing." I mean, there'd be cults talking about how we need to go live in the desert if people didn't even know what it was. You know what I'm talking about?
For sure. I mean, I was one of those folks. I mean, we can go on and on about this. We'll get off this small tangent here in just a second. But this is what I mean. The point of this all is like the news does a good job of taking clips, and that's all you hear, and that does affect not only industries, sectors, stocks. It certainly affects human beings' emotions, right, and their ability to effectively make decisions. But to your point, I mean, a lot of people last year, just a year ago, thought that artificial intelligence was so far away from being able to do anything from a productivity or revenue generating perspective. Well, that idea was wrong. I personally was wrong about cryptocurrencies, not just Bitcoin, but in general. I was way wrong about Bitcoin. And that's been a thing since 2008, 2009.
Right.
It takes a while for even professionals in the industry to come around to some of the new technologies that are out there and available. So, to that point, I guess before we jump into the show and the meat and potatoes of today's conversation, have an open mind as an investor. It would be foolish of you just to completely shut off the idea of any of this stuff being a possibility. I'm not saying all of it's worth investing in. That's for darn sure. That's not true, but at least keeping your mind open to the idea that you could be wrong about whatever it is that's a new technology that people are getting excited about. So we'll cover all this stuff for you about every 2 weeks. So definitely like, subscribe, share the Financial Shepherd podcast because this is the type of stuff that we're going to continue to talk about. So with that being said, now that we get off our little tangents here to start the show, couple things to talk about. I want to start with what has already happened before we get into the first 5 trading days of 2025 and the importance of that. So or I'm sorry, a couple weeks ago, literally the day that my wife is going into the hospital to deliver our third daughter, Wednesday the 18th. So this was just 3 weeks ago. Um, 3 weeks ago yesterday, the Fed had their December meeting, and the Fed did exactly what everybody expected them to do. They cut interest rates by 25 basis points. So it should have been a nothing burger, right? Actually, the Fed should have taken a victory lap. We're going to talk about what the Fed minutes actually show. So we got that information yesterday. So the Fed minutes, just so everybody's aware, every time the Fed does a meeting, or just about every time that they do a meeting, um, somebody's taking notes essentially, right? As to who's saying what and why and all this sort of stuff. And then those minutes, those notes, they get released typically a couple weeks after, a Fed meeting. So this is pretty common practice. We got those notes yesterday, and I want to share with the audience what those notes said because I think a lot of people missed it. Certainly was not talked about in the news, and then I understand why. You have wildfires going on in California. For all those affected by it, we certainly have our thoughts and prayers out to you. Definitely have a few clients out that way that are okay. But we have a lot of other things going on. So this was kind of missed, in the news, if you will. So I want to talk about that and sort of the impact of that, not just for the markets in late December, but also how that might work out into 2025. But the Fed on the 18th at 2:30 made an announcement that everybody knew was coming. 25 basis point cut. That was baked in. Market was kicking ass that day. Our positioning was even better than the overall market. Right around 240, 245, he had to start actually answering questions. So he didn't have his pre-recorded answers. He had to, answer on the fly. And it couldn't have been any worse. The Fed should have taken a victory lap, as I started to say. The reason why they should have took a victory lap during that specific meeting is because 2 years prior, when the Fed started to go on this path of increasing interest rates and then subsequently decreasing rates, the Fed has pulled off what nobody or hardly anybody thought was possible, this notion or the idea of a soft landing. coming out of the COVID pandemic, where we had inflation spike to the highest level that we've seen since the 1980s, early 1980, 81. They've been data dependent the entire 2 years. For 2 years, Ezra, you were here the whole time. I wrote about it for 2 straight years. We've talked about it for 2 straight years on podcast. I didn't always agree with the Fed and their data dependency policy about how they went about, making decisions. I didn't always agree with how they made those decisions, but the bottom line is it worked. That data dependency model allowed the Fed to get interest rates down towards a path that's going to get us to 2%. We're pretty close already, not quite there yet, but pretty close to getting to where we need to be. And the Fed did all of that by increasing interest rates at the fastest clip that they've ever increased them in the history of mankind. They did not destroy the job market, and they got inflation back to a path towards a sustainable 2% long term inflation rate, which is what they're looking for. They've achieved both of their mandates, both price stability, which is inflation, getting that under control, as well as the labor market, not destroying that. They did both things. That is defined as a soft landing. They pulled it off by this data dependency process that they went through for 2 straight years, and it worked. That's what he should have said. He said, "Hey, we're going to go into 2025 with the same idea, data dependency. We got this new administration coming in. We're not 100% sure when they're going to implement these policies that they ran on or how it's going to affect things. So we're going to let the data come in and we'll make decisions meeting by meeting." That is all he had to say. He should have taken a victory lap. We would have taken a victory lap here at Shepherd Wealth Management because we were beating the market. And then after him not taking that victory lap and basically saying, "Hey, we're going to project what we think the new administration is going to do and how that's going to affect the market. Therefore, instead of 4 cuts in 2025, we now think, because of the policies that they want to implement, we think that we're only going to cut rates by 2 times at 25 basis points apiece." It set the market on fire as soon as he said that. At 2:45 p.m. Eastern Standard Time on the 18th, market went from plus positive 1% across pretty much every major average to every major average in the final hour being from plus 1% to everyone being down at least 3%. The small cap Russell 2000 index was down the worst. It was down more than 5%, even though it was positive plus 1% before he started answering those questions. So, again, the man did exactly what the whole world thought he was going to do, but there's no way that the market should have had that sort of reaction with that level of anticipation coming. Usually, you see that sort of reaction when the Fed does a 180, does something that nobody expects at all. Why they decided to be forward looking now is beyond me. Makes no sense at all. It'd be like trying to solve a math equation with basically no actual inputs. You just have a whole bunch of variables, right? How the hell are you going to solve for that? The truth is, you can't, which is why they should have continued with their data dependency. However, we have a way to handle this here, and I'm going to talk about that. But first, I want to actually share with the audience direct quotes from the minutes of that specific Fed meeting because I think it has a lot to do with not just how the market reacted, but how I think things will play out going forward. So, first of all, there's lots to talk about Trump tariffs and policy. I mentioned that. Quote, inflation in 2025 was expected to remain at about the same rate as 2024 as the effects of the staff's placeholder trade policy assumptions held inflation up. They literally said our assumptions for 2025 are holding inflation up. They thought pre the election, according to this, you can assume, again, since September of last year, they had 4 cuts baked in. Then the election happened in November. Now they're talking here mid December. They had anticipated before the election that, inflation would be in 2025, much like it was in 2024. So slowly going back down to 2%. We had 4 cuts this year. Therefore, 4 cuts since September, which was their policy in 2024, made a lot of sense. But now the election's already taken place. That we're in a December meeting here, and their assumptions, direct quote, trade policy assumptions held inflation up in this meeting. And it goes on to say, therefore, inflation was forecasted to decline to that 2% target by 2027, the same as in the projections at the November meeting. In other words, they thought that 2% would happen in 2026. They've now pushed that out to 2027 because their assumptions of trade policy. This is uneffing believable, right? I mean, how nobody, first of all, the people that are sitting there, these folks from various news outlets, the New York Times, Barron's, CNBC, all of them are there, right, listening to the Fed chairman talk. I guess we were too close to the Christmas holiday, and everybody's brains got shut off because he got the same people asking the questions on every one of these meetings that he does. How in the hell, if you're sitting there and you've been there for 2 years, like I have, listening to data dependency, and the whole time these people in the news media are like, "Hey, why can't you use some forward-looking indicators as opposed to just using this data dependency process, which is you making decisions on stale data?" Right? That's some of the frustration that I had with the data dependency model. You can go back and watch YouTube videos that we've done over the last 2 years, and you'll see all of that multiple times, by the way. But the point is, they got it right by being data dependent, even though I didn't necessarily agree, even though necessarily not all the folks in the media agreed with that data dependency policy, but it works. So, how in the hell, again, going back to this, when you're getting these minutes, why would you not ask? Well, if you were data dependent for 2 years and it worked, why would you change that now? What makes you want to look forward just because we had an election? Makes no sense. Those are good questions to ask, but nobody effing asked them. Doesn't make any sense to me. All right, it goes on to say there is also lots to talk about the Trump tariffs policy continuing. And quote, a couple of participants judged that positive sentiment in financial markets and momentum in economic activity could continue to put upward pressure on inflation. Could. I mean, what the hell is this? It basically they're saying that these Fed professionals, these are economists, esteemed, intelligent bankers, essentially. And they're saying that the sentiment in financial markets, just because you're a market participant and you're excited about it, they're trying to factor that in, and the momentum of economic activity could put upward pressure on inflation. You got to be effing kidding me. How about you try to take into consideration the impact on the price of oil, right? As one of those things, right? That you're saying that you're factoring in as a Fed governor trying to make decisions on policy, monetary policy, right? Increasing rates, decreasing rates, keeping them the same. Well, you already know that they want to unleash some of the energy here in this country, and they've already done it in a prior administration for 4 years. Price of oil was quite low. When you increase supply, that's what happens. And if the price of oil is averaging, let's just call it an average of $70 a barrel, it could be lower than that, could be a little higher than that, but I highly doubt it's going to be approaching $80+ a barrel, which isn't a bad price for the price of oil for sure. From a historical perspective, but if oil is going to be around $70 a barrel, let's say on average for the next 4 years, you're going to have a damn hard time making a case for inflation, given the impact that the price of oil has on everything across every major sector. So it goes on to say, quote, all participants judge that uncertainty about the scope, timing, and economic effects of potential changes in policies affecting foreign trade and immigration was elevated. Again, they're projecting out their thoughts about potential policy that may be implemented that may affect market participants, the economy, immigration, foreign trade, etc. And it wraps up here in this particular sector, and I'll have a couple other things to share. Reflecting that uncertainty, participants took varied approaches in accounting for these effects. Basically, what that means is some of these participants, these Fed governors, were trying to use their own assumptions and projections in their December rate decision. Some of them didn't, and some didn't say whether they did or didn't. So you got a collective group of these quote professional bankers, these very well educated group of people that are trying to make monetary policy decisions, which is going to affect the interest rate on our national debt that the US government has to pay. It's going to affect things like credit card balances, mortgage interest rates, you name it. Anything that has to do with a loan, borrowing, in any way, shape, or form. The Fed is trying to basically say all these other variables that we can't understand the timing, impact, or implementation of them. We just think that they're going to have some impact. We have to make our adjustments to interest rate policy. You got to be effing kidding. This is the reason why the Fed doesn't have any damn credibility. They talk about credibility when we were having this inflation issue. Again, you can go back and look at these podcasts back in 2022. They talk about their credibility all the time. This is why you don't have any damn credibility, man. You could have gotten a ton of credibility saying, yeah, we were dealing with a global pandemic, unlike anything we've ever seen in mankind history. We took some extreme measures from a fiscal policy perspective, led to some inflation. Obviously, the supply chain didn't help with that after shutting down the whole economy. We took a data dependency approach to deal with things that we didn't know how it would impact stuff. Therefore, why should we look at that any differently in 2025? Should have been a victory lap, folks. But again, this is what a group of 20 professional bankers decided to do. I wanted to point out something again that I think was dovish in the minutes, and I think a lot of people missed. And again, the news didn't cover any of this stuff, but we also had other things in the news going on. So here we go. Quote, some participants observed that in the core goods and market based core services category, excluding housing, prices were increasing at rates close to those seen during early periods of price stability. In other words, inflation's back to trend. That's certainly a dovish statement to make. Many participants noted that slowing in these components of inflation corroborated reports um, in recent business contracts that firms were more reluctant to increase prices. In other words, a lot of companies had to increase their prices with the supply chain problems, the inflation problems, right? That we've all experienced and still experiencing. Um, but those companies that did have to increase prices, they're not continuing to increase price. In other words, there's no greed inflation. Trump mentioned this the other day. I've mentioned this many, many times. When inflation happens and prices go up, they generally have a very difficult time coming back down. This is the reason why bread doesn't cost a nickel, even though we might get inflation back towards 2% or even lower. When bread did cost a nickel, damn near 100 years ago. So that's the reason for that. So there aren't any companies that are trying to continue to increase prices, which is a good thing. And with respect to core service prices, that core PCE number did in fact come in at point 0.1. The market was looking for point 0.2. It came in at half of what people were looking for. Again, that's a dovish statement that the Fed governors made. And lastly, increases were concentrated largely in non-market based pricing categories, and that price movements in such categories typically have not provided reliable signs about resource pressures or the future trajectory of inflation. In other words, this is the statistical lag effect that we know um, monetary policy has on the economy. I mean, these are all dovish statements. But in the very first beginning of it, it's like, hey, we're going to make these assumptions. We have no freaking clue about any timing, implementation, effect of it. But we're going to take away the Santa Claus rally from you guys because now we're going to be, because of this election, now we have to be clearly, we have to be forward looking. I have a lot of things I'd like to say right now, but I certainly cannot say them without losing some market and audience participants with the language that I'd really like to use here, because
Unholster it, man. Take it out the holster.
it's not a political thing, man. You're running an organization that was established by Congress. You answer to Congress. There is no political bias with that uh, entity being the Fed, right? They
Yeah,
have two
and wasn't
jobs.
Powell even appointed by Trump?
Yeah, he was appointed by Trump. Now, Powell is a Democrat. There are a lot of Democrats in the Fed governors. There's certainly Republicans too.
Sure.
That's not the point
No.
at all. This is not. I don't know why they made themselves. They basically, with this decision and some of the things that you're talking about here, they made themselves. They put themselves in a political light and lens that I don't think they really wanted to. Maybe they intended to. I'm not sure why. I don't give a rip about their politics at all. What I want them to do is to continue to do their job effectively, which is bringing inflation back down to 2% and without destroying the job market. You've done a great job of that over 2 years, even though I didn't necessarily agree with all the ways in which you went about making your decisions. Now I have a huge problem with how you're trying to make decisions because you guys have a terrible track record of trying to predict things, right? It almost always goes wrong from a Fed's perspective. So I don't care about your politics. What I do care about is the effectiveness of your job. And you're, to me, losing credibility by trying to make this calculation using variables where there is no concrete data at all. I mean, you might as well have just had a press conference. Say, hey, we have a hypothesis and we want to test it. Right? That would have been the same thing, same type of conversation. So it's unbelievable to me. But this is the reason why, folks, that the market had the sell off that it did over the last 3 weeks. Okay. It had nothing to do with corporate profits, it had nothing to do with investor sentiment. Um, there was nothing that really changed. The only thing that changed is the Fed decided to be forward looking because we just had an election. And that certainly caused some problems here in the short run. But the good news is this is certainly short term. And I have some pretty exciting stuff here to talk about with the audience at this point. Now that we've covered, the reasons for the significant volatility that we've seen over the last 3 weeks. Now that we're in 2025, we've just completed the first 5 trading days as of the end of the day yesterday. And the reason why this is important is because since 1950, when the first 5 trading days are positive, the full year average for the market is 13%, which is pretty good. That would imply the S&P getting to about 7,000, which is what our target is for this year. 82% win ratio when the first 5 trading days are positive since 1950. Markets average 13%, and about 82% of the time, the markets are positive. And because it's an average of 13%, certainly some years were much better than 13, some years weren't as good. But we just got off back-to-back double-digit 20% years in the S&P. So to see the first 5 trading days being positive is definitely a welcome sign. Just for those that are curious, if we had the first 5 trading days being negative since 1950, which is not the case, but just for those that are curious, since 1950, when the market is not positive in the first 5 trading days, the full year average return is 3%, and the win ratio is 54% of the time. So that's a huge difference, a huge delta between the first 5 days being positive versus being negative. So certainly something that is a welcome sign here as we begin the new year. Now, the University of Michigan survey came out for inflation expectations. Inflation expectations are normal. If we go back to the pre-pandemic, the average was right around 2.8. Guess where we're at? 2.8. And the 5-year expectation is at 3%. So these are all normal numbers here. Um, on top of the first 5 trading days, being positive, which is again a very welcome sign. Now, with the first 5 trading days, um, this rule has certainly worked in recent years as well. So I know I gave you the number since 1950. I found the number that I was looking for here since 2015. So just in case you want to use some more recent history under the same pretext with the first 5 trading days being positive, the S&P 500 has gained or been positive 5 of 7 years. So it's been 7 years since 2015. So 5 of 7 years, S&P 500 gained a positive return. The only losses were in 2015 and 2018. And in 2018, the Fed was very hawkish. The other five were 2017, 19, 20, 21, and 23. And all 5 of those years, markets were up 20% or better for the full year. Now, that's pretty fantastic. Um, Part of the reason why the market has struggled here over the last 3 weeks, on top of what the Fed had to say that sent interest rates up, the 10-year Treasury um, basically went up to near an all-time high of about 4.69%, about 4.7%. Not quite that 5% level that we saw about a year or so ago. But with the interest rates increasing like that on the 10-year, that is counterproductive for the Fed as well. The Fed is trying to be loose with monetary policy. That is by reducing interest rates. So every time the 10-year goes up, like it has here over the past 3 weeks, because of what the Fed had to say on the 18th, every time you see that 10-year increase the way that it has, is counterproductive for the Federal Reserve. It actually makes them more restrictive than they otherwise would like to be. So this is like a coiled spring that we're building here right now with all this anticipation with what the Fed's going to do, and are they even going to cut rates this year? And some people are like, damn, are they going to actually increase rates this year? So that's why you're seeing the 10-year Treasury interest rate, rise towards that 5% number. And again, the reason why I call it a coiled spring is because if the Fed is wrong, which there is a damn high probability that they're wrong. Okay. I'm betting against the Fed here. And by the way, the Fed is still your friend when they're cutting rates. So you should want to be a market participant. I just gave you the historical averages on top of that. Plus, the Fed gave you some dovish comments after they admitted to the fact that they don't really know what the hell they're doing with these assumptions, but they're going to make them anyway. Um, so with that, we have a lot of things for investors to digest, of course, and all of that uncertainty provides some volatility. But when interest rates are going up, as they have over the past couple weeks, that is definitely counterproductive for the Fed. So the coil spring effect is this: if the Fed is wrong, they've already set up the market for one rate cut, which is priced in today. Well, what happens if we get three rate cuts? This is what I think we're likely to see here. Might see four, but I'm thinking at least three cuts in 2025. So this coil spring effect is okay, the Fed was wrong. Therefore, they have to cut rates more than they anticipated at the beginning of 2025. That's great for stocks. On top of the job market not being destroyed, that's even more bullish because we're more productive with even lower interest rates. And on top of a administration that's planning to cut rates, or not cut rates, cut taxes, roll back regulation, and increase energy productivity, all of which are disinflationary, right? That's that cold spring effect. That the Fed is wrong. And now that we've had the historical precedent, the first five trading days out of the way, I'm not saying this is 1996, 97, where we've had a great first half of the year, followed by a amazing second half of the year. It might be that. The reason why I bring up 96, 97, we talked about this in a newsletter that we wrote to clients at the beginning of the month here, is that coming out of back-to-back double digit, or I'm sorry, back-to-back 20% plus years in the S&P 500, that's happened five times since 1881. That's right. We went back to 1881. So it's happened five times. Five of five times, the market was positive the first 6 months, and the back 6 months wasn't as good. In some cases, negative. One out of those five times was 96, 97, where the back half wasn't as good as the first half, but it was still damn awesome, where we had a 30% type of year or close to that, 25 to 30% type of year. So I'm not saying that we're there yet. I think that this new administration is going to have to get in, try to do what they're hoping to do, and we'll see what the actual effects are of that. And certainly there is a bullish case to be made, but history has lined up really, really nicely for the first 6 months. I think it's prudent to be nimble. By the time we get to the latter part of Q2, right before the summertime, going into the back half of the year, it's going to be important to be nimble, I believe, and it might not be a bad idea to consider protecting some gains. I know that that's something that we're talking about clients with right now for the first time in 3.5 years. We've done a great job of outperforming over that period of time, ton of gains. Talking about strategies to protect some of those gains, giving some of the back half uncertainty that could come into play in 2025, on top of a Fed that really doesn't know, how they're going to go about making decisions right now. So there's some uncertainty for sure out there, which is a reason for wanting to be nimble and considering protecting some gains. That's why one of the reasons why we do quarterly reviews with customers every single quarter is not just to talk about performance, how we got there, why, expectations for the following quarter, and then for the rest of the year, but it's also to reassess the risk tolerance after just three excellent years that we've had here for customers. So my final notes for this particular podcast is this type of program that you're watching here today, the Financial Shepherd podcast. This should be a go-to for you, whether you catch this live every 2 weeks or you catch it after the fact. The news does a terrible job of giving you historical precedents. I can understand, like, if you're a mom, taking kids to practice, driving all over the place, you got work schedules, you got dinner. Maybe you're, a married guy or even a single guy. I mean, you got all these different pressures on you, and all over the world. I can understand why people would freak out when all they do is they see the performance of that day, S&P, Dow, Russell, whatever, NASDAQ on their phone. and they saw nothing but awesomeness in November and early parts of December. And I'm sure they woke up one day after work or after driving their kids around, had a minute to check their phone and saw nothing but red, and probably had the worst feeling, especially after, 2 years of 20+% gains. People sold first and they asked questions later. I don't even think they're asking any questions. I mean, for sure, the people that were sitting in that Fed presser were not asking the right questions. And I can understand how those emotions would take over control and ultimately have you selling during the last 3 weeks. What we did is we actually rebalanced. We had a major weighting in small caps. We talked about it all year last year. It was a positive performer for us, but it didn't do the types of things that history said it likely should have. But now we're in this quote higher for longer situation with the Fed, meaning that they're not anticipating or not in a hurry to cut rates. They will be cutting, of course, at some point in time this year. They don't know when. I believe that that'll start to happen in March, and you'll probably see at least 3 cuts this year because I think the Fed is just simply wrong with how they're trying to project, what may or may not happen with new policies from this administration. So, a lot to look forward to, a lot to pay attention to. You'll want to be listening to this program. So please like, subscribe, and share. And you'll be up to speed on what's going on and why things are happening the way that they are. And more importantly, what does history have to say about the events that we're dealing with? So we'll hope to see you guys back here in a couple weeks. And we'll continue to deliver the same type of content. So we'll see you guys. And latter part of January here. We'll be through the inauguration day, so there'll be a lot to talk about as it relates to that. We'll see what that first day looks like from a executive order standpoint. I'm sure there'll be a stack of that, a lot to talk about there. Then, of course, we'll have a Fed meeting kind of jammed in into the latter part of January as well. So, a lot to look forward to. Hope to see you guys in a couple weeks. With that, have a great rest of your Thursday and take care.